Hello to everyone. Today I am going to present my presentation on financial modeling. If you are interested to have update videos on finance and banking related topics, please do subscribe my channel. Now, here we are going to discuss what is financial modeling or how you define the financial modeling, what's the objective, uses, and its significance. These topics we are going to cover in this presentation. First of all, define financial modeling. Process of creating a summary of a company's expenses and earning in the form of spreadsheet that can be used to calculate the impact of a future event or a decision. So first of all, it's a working on a spreadsheet. Normally we use Excel to develop the financial modeling in order to develop the future projection for any type of businesses, and that help us to take our financial decision. Mathematical representation of a company's financial performance used to forecast future outcomes and make information informed decisions. So in other way, it's a mathematical presentation in order to evaluate the performance, past performance, and to forecast the future performance. And in a similar way, the different type of the future outcomes related to businesses is a part of financial modeling. We can also explain it as simplify a spreadsheet which is usually built in Microsoft Excel that forecasts a business financial performance into the future time. So these are the simple definitions for the financial modeling. Objective of a financial modeling to combine accounting, finance, and business metrics to create a forecast of a company's future result. So here it's a combination of basically on one side accounting, other side the finance, and third one is the business. So it's the metric that help us in order to develop the forecast of the company's future performances or future result. It's the core objective for the financial modeling development. Uses of financial modeling used for the decision making and future financial analysis related to, first of all, raising capital. Because in order to start any business, we will have to raise the capital. First of all, we will calculate the capital requirement. Thereafter, we analyze how we used to raise that capital. Capital is divided in two parts. First is capital debt, and other one is capital equity. Capital equity is basically the owner's equity or owner's contribution within the business. And capital debt is the part of the borrowings that can be from family and the friends, associated companies, directors, and from financial institutions. Making acquisitions, business, and or assets. So it is important we have to calculate the requirement, and on the basis of the requirement we will go further. Growing the business, growing the business organically. So for example, you are going a new business in the shape of a new grocery store or entering in the new market. So it is one of the use for the financial modeling. Selling or de-listing asset or business unit, budgeting and forecasting. So budgeting and forecasting is very important. You plan for the years ahead. You develop the budgets on the basis of required resources, and thereafter you forecast your financial model and plan your financial model in order to meet those resources requirement. Capital allocation, priorities of which projects to invest in. You can go for one or two or more options, and you develop the financial model for those options, and thereafter you set your priority in which sector or in which project you should invest your money. Valuing a business, financial statement analysis and ratio analysis, management accounting. These are the uses for the development of financial modeling. Now, financial modeling significant. First of all, strategic planning. Organization develop their future long-term strategic plan and projection, considering the different possible scenarios that can affect their decision. So strategic planning is one of the most important part of financial modeling. On the basis of that, you make your plan and develop the projections according to the plan. That can be in a normal economic scenario, in a booming economic scenario, or in a worst economic scenario. So you keep in mind all types of the events or scenario for an effective strategic planning. Thereafter, risk assessment, helping to identify the severity of associated risk by applying the sensitive analysis and stress test that help the organizations to find the way to mitigate these risks. So in the beginning, you assess the different type of possible risks, maybe because of the economic setback or any due to any operational failure or other type of the failures. On the basis of that risk assessment, you also should develop the remedial plan. Sometimes what you are considering and what you are planned is not matched according to the market norms. So in this way, you should have a remedial plan to meet those challenges. Capital budgeting helps business align their investment decision with their overall strategic objective and the goal. Analyzing the cash flows meet the expected benchmark return. So here, capital budgeting technique is one of the most important techniques that help you to align your business with your objectives. Objectives are normally set for the department and goal is set for the overall business organization. So here you develop your cash flows and assess either your cash flows meeting your benchmark return or not. Definitely on one side, you will have to earn to meet the expectation of the owner's investment. On the other hand, you have the you have to pay against the debt that you are going to generate. So the benchmark is developed by considering the expectation of the owners, and on the other hand, uh, the payment against the debt that you have inducted within the business. Valuation help to evaluate the company's worth for investment decision like merger, acquisition, etc. Provides a framework for the estimation of the business based on the different factors like earning, asset, market conditions, environment, and economic. When we say market condition, it includes both the environment and the economic condition. On the other side, you should know the meaning of the merger and the acquisition. Merger is the combination of two or more companies. Two or more companies can merge as a single company. In that case, you will have to evaluate the residual value base. You have to develop and evaluate the residual base financials of each company. Now, one company can be a weak company, another company can be a strong company when they are going to merge. In that case, a proportion of the um, shares price should be evaluated, and on the basis of that share price, you should go for the merger. In case of a acquisition, you acquire the total company as a single entity, or you can say acquisition is the transfer of the ownership as well. Fundraising, it is very important to meet your capital requirement. You should know from where you can raise the fund and what are the possibilities for raising the fund. So that part helps to estimate the capital requirement to develop the best financial mix. Now, in order to raise the funds, we have normally three types of financial. One is the equity, and other one is financing from the family and friends. On the other side, from directors, associated company, and financial institutions. The third type is you can generate the fund by floating your own debt instrument like bonds or term finance certificate. The difference between the both debts, one is to borrow from family and friends and financial institutions and to generate the funds against the IPOs, initial public offer, like bonds and TFCs. Those funds you can utilize according to your requirement. But particularly when you go for the long-term funding from the financial institution, you are bound to go for any type of asset expenditure. So it's a basic difference. It's you will have to set the priority for the best suitable financial mix and at what level, which type of the financing can be favorable for your business. Communicate the financial health and growth potential of a company. Credit rely on the model to make informed investment decision. Creditors rely on the model to make informed investment decision. The comprehensive and you can say the logical and a true model always help for fundraising. Performance analysis. Businesses develop comparative analysis of their past performance with projections and with of similar size businesses. Now here on one side, you go for your own comparative past history performance of 3 to 5 years. On the basis of that, you calculate your growth. On the other hand, if you are going to index further capital expenditure in the shape of machinery equipment and you are also going to enhance the size of your business, in that case, you will definitely add the incremental cash flows as well. On the basis of that, what's your present size? You can compare your performance with a similar size, and after the enhancing, definitely you may have need to um, generate from the other side, from the you may have need to develop the comparison of any different business. Help to identify the weak areas for improvement and optimizing the financial strategy. Now here you have an other question that is related to identify the weakness and how you will able to identify your weakness and how you overcome your weakness by bringing the improvement within the financial strategy. Resources allocation help to develop the department budgeting based on the time management, their financial impact, and to align with the strategic goals. So here, resource allocation include all type of the resources like human resource, and on the other side, your capital expenditure requirement and capital as well. So that is also a part of the budgeting. Budgeting used to be developed or revised on yearly basis according to the change in the requirement and change in the with the, or you can say with the growth within the business. Cost control help in monitoring and controlling the cost by providing insight into the cost structure and cost drivers. On the other side, enables organization to identify the area where cost reductions are feasible, help to develop the product and department-wise cost benefit analysis. Now, cost control is very important, particularly when you have the high energy cost and everything is going to be out of control for your consumers as well. You will have to bring the cheaper products as well. On the other side, you may also have to uh, develop the cost benefit analysis for each product. Cost benefit analysis is one of the most important tools. Sometimes you have to eliminate the those products which are not cost effective, and similarly you will have to merge the department which having the higher cost as compared to their benefit to the business. Scenario planning help for the development of scenario planning by applying sensitive analysis and stress test, keeping in mind the uncertainty within the economic condition. Business should have in advance remedial plan to meet such scenario. Sometime you have the remedial plan, sometime even having the remedial plan, you have to lose a lot. We have the example of the COVID-19 where a number of the businesses shut, provided having in-depth their analysis. So such uncertainties can also be a part of any business. So here sometime diversification works more. Cash flow management help in forecasting cash flows based on the different scenarios, highlight the company's liquidity, surplus or deficit to meet the financial obligation, uh, basically capital budgeting technique and other cost benefit analysis. They are not possible without developing or without having a proper cash flow management. Or you can say cash flow management lead towards particularly cost effectiveness. If you are managing your cash effectively, how efficient your cash flows are, that is based on particularly on three factors. On one side, efficient receivable, efficient payable, and efficient inventory management. They play their role after cost effectiveness for the effective cash management. Investors communication, public limited often communicate their financial performance, growth perspective, and the future strategies to their stakeholders that include creditors, investors, shareholders, and the employees. That they should know about the present position of their company, and growth as compared to the past position. If there is a deterioration, they should know the reasons for the deterioration and what are your future strategies that should be communicated to all stakeholders. Decision-making model develop on different businesses according to available resources, keeping in view the forecast that include the capital, profitability, associated risk. Decision maker have choose for the selection of the best suitable one. So decision making is the key drive for the success of any business. If you have taken the right decision, normally the middle management used to recommend their strategy to the senior management, and senior management used to take the decision based on the middle management recommendations. Compliance and reporting. Many industry and regulatory body require companies to maintain the accurate financial record and report, assist in ensuring the compliance with these requirements. So sometimes compliance is mandatory from the regulatory body that cannot be avoided or foreseen. Any case, you will have to go for the compliance, whatever enforced by the regulatory body. And similarly, reporting is also for the regulatory bodies. Many times, SCCP used to regulate or other bodies where you are going for the sensitive work. Sometimes environmental bodies, they play their role for their compliance. So it is very important to keep in mind those compliance in order to run your business. Performance metrics help in calculating and tracing key performance indicators such as the return on asset, return on equity, liquidity ratios, efficiency ratio, solvency ratio, profitability ratio, break-even point, and business maturity, etc. So these things you should have to keep on monitoring from time to time in order to assess your performance or any variation within the performance that is deviating from your expectation. Flexibility model used to be adopted by all formal businesses, industries, and sectors, making them a versatile tool for the businesses of all types and sizes. Now, thanks. See you again with the upcoming video on the same topic. Do you have any question? Can contact on my email. If interested to have update videos on banking and finance related topics, please do subscribe my channel. Thank you very much. See you again.